We are joined by the management of Syngene International. Manoj Nerurkar, the Chief Operating Officer of the company, now joins us on the show. Remember that Syngene had delivered its numbers with a sales growth of 40%. Margins were, however, a bit subdued, compressing by 100 basis points, but the bottom line grew by 8% at 84.5 crore rupees. Mr. Nerurkar, thanks so much for joining us on ET Now. A good top-line growth, but, I think the street is a bit upset with what's happened on the margin front. So, could you explain that to our viewers? What's the reason for the decline in margins and the gross margins as well?
Yeah, so as you correctly said, the fourth quarter results are quite good on the revenue side. We have shown an overall growth of about 35% on the revenue. The margins, if you look at, they are also in the range where we have generally delivered. For the fourth quarter, the EBITDA margins are at 34% and the PAT margins are at 20%. Yes, it's 100 basis points lower, but also remember we are making significant investments in business development, in upping our safety compliance capabilities, and even with that, the margins that have come out, which are 20% at a PAT level, are within the range that we have always delivered. So we are overall quite happy with the quarterly numbers. If you look at even yearly numbers, there is a 17% growth in revenue and margins have come out at 35% at a EBITDA level, 21% at PAT level. So overall quite happy with the year's performance.
Hi there, good morning, Mr. Nerurkar. Let's talk about your sequential increase in the other expenses. What has been the reason for this, as well as in your employee costs, and where do you see it headed?
Yeah, so employee cost obviously has gone up. We have been in a growth mode, as you know, as a company, and therefore employee cost is expected to go up. As I also said earlier, we are spending, we are investing quite a bit on the safety front, on compliance front. We are having increasing our presence in US and European markets in terms of business development teams. So all that have increased our other expenses. Of course, all that will pay off in time, because these are the elements that are expected to bring higher growth in revenues as we get into the next year.
Okay, Mr. Nerurkar, along with that, I'm also seeing an increase in the payable days. What's the reason for that?
Well, payable days is one of the things that we track. We don't really see any impact of that on our overall financials. They are still robust. They are still within the trend that we have. Don't really have any impact on the balance sheet as such. The balance sheet remains to be strong and robust.
No, that of course I agree, but from an operational perspective, from a working capital perspective, this is something that would not bode well. So if you could just, is there any exceptional reason, is there any exact reason for this increase in payable days? Because it is quite substantial.
Yeah, but this is the kind of trend that we keep seeing quarter on quarter, especially in the last quarter, as it is our financial last quarter, is the first quarter for our clients because their financial years start, and generally we do see this kind of a spread year on year. So I won't read too much into it in terms of sequential quarters. Overall, it is within the range for us, and as I said, it still gives a very, very robust balance sheet. There is no particular exceptional trend that's emerging here for that particular number.
Okay, let's talk about also your capex plan. I believe it's about $200 million that's slated. What exactly will the proceeds be used towards? Are you looking at upping the overall capex?
Yeah, so $200 million number that we had for capex was earmarked for a new commercial API manufacturing facility in Mangalore. The construction of that facility is in full-fledged. We have quite an aggressive plan to bring that facility online in FY20. and those plans are absolutely on track. That itself is about $100 million capex that we have already earmarked. The remaining $100 million also has gone into a new formulation facility that we have built, a new biologics state-of-the-art manufacturing plant that we have built that will go towards manufacture of biologics or the antibody kind of molecules, which are quite new interventions in terms of how pharma companies are looking at treating patients. So these three are essentially the reasons why the 200 million capex has been earmarked, and it's being spent as per the plan in terms of cost as well as the timeline.
Could you also talk to us about the long-term contract that you've entered into with GSK for discovery research?
Yeah. Well, we are extremely excited about the GSK contract. As you know, GSK is world's one of the largest pharma giant, and a strategic collaboration, large strategic collaboration with them to support their discovery research, to give them new molecular entities, the new candidates which will become medicines that will help the patients worldwide, is something that we take tremendous pride in. And this collaboration really kind of underscores Syngene's ability to do contract research at a cutting edge and offer these kinds of medicinal interventions to help patients. So extremely excited about it. The collaboration has just started. It's a multi-year collaboration, and we really look forward to working very closely with GSK scientists to develop new medicines that will offer cure to various diseases for the patients around the world.
Okay, that sounds very exciting, and we look forward to see how that partnership really progresses. Mr. Nerurkar, thanks so much for joining us on ET Now and helping our viewers understand what exactly went by for Syngene. A good growth on the top line. Margins may have disappointed a bit, but nevertheless, the management's not worried about that. They're saying that that's on account of investments. Costs may go up going forward.